on a Friday morning. Hopefully, look all Thursday morning. I was thinking it's Friday, but maybe I need the weekend soon. This is our first quarter one analyst call. Before I get started, as it was introduced, I'm joined by Mr. Bharatan, Director of Refineries, Srividya, who's just joined us as Director of Finance recently. We are very privileged to have her as part of our board, and this is her first call, and I'm sure you're going to hear from her now and even going forward. K. Vinod, who you know from the past, and all the other colleagues. I was preparing my opening thoughts for this, and that we'll follow the same pattern which we've been doing in the last call. I'll speak for 5-7 odd minutes and then open it up for a Q&A. So we last spoke on 13th of May, and I was reflecting last night as I jotted down some points on what the quarter was. It seemed to me circle of life, and twice over in this quarter. It almost seems we seem to live a lifetime. Why did I make that comment? Well, we had the Rajasthan refinery. There was a high on 20th July waiting for the inauguration. An incident on 20th April waiting for the inauguration. Incident of a small fire in the CDU. We had to postpone it, and then we recovered from that. And July 4th, we dedicated that asset to the nation. That was one circle of life. The second one was on the performance. 13th we spoke on a high of 17,175 crore of FY26 to the negative of this quarter, which I'm sure you have analyzed ad nauseum since last evening. That's the second circle of life. These are times we live in. You all have also agonized it on Excel sheets. We have agonized on it on a daily basis over the last quarter. Lot of challenges. We'll talk about it, but very proud of the way our team fought it on a daily basis bravely and managed to keep the supply chains going in times of high uncertainty. At moments like these, we take high and low in our stride and move forward. Coming to the current situation, I will not talk much about it. All of you track it. We know the uncertainty which prevails. Just one benchmark talks about it. What was crude 30 or 40 days ago? What was it 20 days ago? What is it now? So that's a highly uncertain situation. It poses 4 key challenges to any team like ours which is operating on it. First, extreme uncertainty on price. I talked about crude. At one point in time, you are taking a benchmark which is going, Brent is going into 110 and 115. You are buying it in 1.5 to 2 months in advance, and then suddenly it drops $25. What do you do with that inventory? And by the time you figure that out, it goes up to 96. So extreme uncertainty on prices, and also not only on the crude, also on the cracks. So cracks have been less volatile, though they have been consistently high. Second, on an operating basis, we had to take, or any refiner had to take, a lot of decisions based on availability rather than optimization. So during this period, most refiners, most certainly us, could not run the most optimal crudes we would have want to run for our assets, for a very simple reason. Some of them were sitting on the other side of the Strait of Hormuz. There is no way of getting them out. So a lot of non-regular crudes. The idea was to keep the throughput going, and as a refiner which is working, refining and marketing company which is working to keep the wheels of the nation in motion, we had to make sure the throughput was there. So we didn't have that option of going down on throughput, or we didn't exercise that option. Third, there were demand pressures. If some of you have tracked the industry, there have been spike in the demands. There were days when our supply chain was required to put in 40% more product into the market. Those are not things which are usual. You can all imagine what kind of challenges exist on the supply chain. And last point I want to say, it's a constant challenge. Many of us in services industry, I belong to that industry, often get Saturdays and Sundays. I would say our teams don't get that also. And the fact that it is now going for 120 days is not, leads a lot of wear and tear. Having said that, I will once again reiterate, I'm extremely proud of the way HPCL has performed, notwithstanding the numbers, and I know we will get a lot of questions on the numbers. We are ready for that. The organization has delivered under the crisis, kept the assets running, and it's managed to keep the customer expectations going. As I said, it takes a lot of effort to manage the crisis, and the teams are focused on it. Yet, as we were doing it, we are also keeping an eye on the future and taking some fundamental improvement initiatives. The numbers are all there, and I'm sure everybody's looked at it. I chanced upon at least 3 or 4 flash reports from analysts. I read them, and very fair observations by many of you. And we'll address those questions in our thing. What I wanted to cover in the remaining part of my opening dialogue are just 2 things. One, just a couple of key events which have happened in the recent past. And then I want to talk about, which I'm sure you want to hear, what is our response strategy to the current situation. On the event, the biggest one was HRRL. Finally, we have a running refinery in Rajasthan, Rajasthan's first refinery. We declared scheduled commercial operation on 22nd June. The refinery is ramping up. As of now, CDU is running at 60% capacity utilization, and slowly we will get the other trains of downstream units going up. Diesel, MS, and a lot of other units are there, and likely today, tomorrow, PSCCU, which is one of the money spinner units of the refinery, is also going to be in line, and a lot of effort has gone onto it. We are expecting the refinery to ramp up to the full capacity in quarter 3 and petchem by end of the financial year. But the refinery gains and running the CDU at full capacity would be at quarter 3. During this period, we have already tested the CDU at a full capacity run for a period of couple of days. So right now we are running it at 60% utilization. Second was an exciting small pilot, but I wanted to highlight it because it shows you the mindset on what we are operating at. Some of you might have got the news of our latest LPG product called HP Navya. It was launched on 15th July, which was our 52nd foundation day. It's an on-demand premium LPG product sold through new channels, new look of cylinders, new delivery mechanisms, new channels. In Bangalore, we are piloting it with Swiggy. Right now, it's available in a radius of 5 kilometers, but slowly will be ramped up. In Mumbai, we have started it through our own channel. We are expected to hit 5 more cities by 31st July and 25 cities by 31st August. And pan-India, it will be mostly urban-centric, so pan-India about 200 to 250 cities by Diwali, which is the game. The idea is to move some of the for people who are willing to look for comfort, who are willing to look for better service and pay a price for that. LPG will be available in a different mechanism or different mode in India. No longer waits, and no longer you will have to call up people to get an LPG cylinder. You can go and pick it up from your neighborhood shop. There are some other interesting pilots which we are doing on use of biomass and fuel. I'll not talk of it there. In subsequent meetings, we'll probably cover that. Obviously, we have. I'll come to the second point, which is the response strategy. You've all seen the numbers. As a management team, any such numbers disappoint. They don't surprise. You can always say there was a margin of surprise in the end because of, I would say, inventory write-downs, etc. But we knew what was coming, and we have prepared our response strategy on it. There is a 7-pronged response strategy which we are working on, and I will elaborate that. At the end of it, then I'll stop and open it up for questions. First is about improving our balance sheet. What gave us strength at this point of time was the fact that last whole year we had improved our balance sheet. Those of you who had been on the calls would recall that our debt equity had changed from 1.43 at the beginning of last year to 0.8 at the end of the year. That gave us the headroom to withstand this crisis. Right now, it has risen up to 1.5 again. The debt is 72,000 crores. And as we speak, we added about 1,900 crores a week during this period, last 13 weeks. But this organization knows how to correct it. At the Ukraine crisis, the debt equity went up to 2.33. It came down to 0.8 in about 3 years. I'm very sure it will come down faster this time, and this will be one of our first objectives on making sure we climb down on the debt equity and create that headroom again. Very difficult to give a forecast given the prices there, but obviously this is on top of the agenda for Srividyani and other corporate finance team, literally looking at it on a daily basis. Second in response to the time is the capex control. As it is, we had set a lower capex. Most of you who have tracked us for a long time know that we are at an end of a long capex cycle. Things are starting to fall in place. Taking a bit more time than we would have liked in terms of stabilization, but nevertheless they are falling in place. We don't have to spend that much of money. As a result, our annual target, which we have agreed with Government of India, if I remember correctly, is somewhere in 9,700 crores or in that ballpark. In the first quarter, we spent about 1,700 crores roughly, and all of that is, I would say most of that is essential things. You still have to spend on turnarounds, and you have to plan for your turnarounds, etc. You have to buy the cylinders, all of it go in capex. So at this point of time, we are really focused on, especially in the short-term money outflow, on really critical capex. It's very tightly managed and prioritized. If the current situation prevails, we would expect the capex to be lower than 9,700 also. We want to conserve cash as a management team. Third response strategy is interest costs. With the rising debt, we do have interest costs, so they have been very tightly managed. And last year you saw how we came down on the interest costs there. Right now, a couple of things we are doing, looking at all kinds of avenues for our parent balance sheet and also the HRRL balance sheet, which is the bigger subsidiary debt or joint venture debt we have. Obviously leveraging the ECB window, etc., some of those things. But the idea is to get our interest costs in control. The seriousness of this you can know from, if you track our receivables, you'll see how they have come down and have stayed down. Fourth response strategy is profitability improvement, making our assets work more. You had tracked us on the Samriddhi program last year. We came in with about 1,600 odd crores. I don't remember exactly the split between recurring and one time, but the recurring ones have already been baked into this year's plans. Of course, with what happened in the first quarter, a lot of plans got topsy-turvy, like last-minute movements, etc. But nevertheless, we have reinitiated after hiatus of about 3 months in the crisis. We have reinitiated Samriddhi 2.0. We already are working on 100+ idea. We have taken, despite only 9 months left in the quarter, or 3 quarters left in this year, we have taken an aggressive target of 1,500 crore on a run rate basis, and we are going to aim for 1,000 crore on accruals in this. This would come in 3 or 4 forms. There is obviously cost takeouts. There is also an emphasis on a top-line improvement. Again, happy to give you details now or later in the call on one-on-one discussions. And then there are also some of the things we are trying to do more on intermediate movements which can saturate our refineries, etc. better. More on that topic in one of my next response strategies. The fifth one is winning in retail. Some of you tracked, we are at the end of a marketing company. Very proud that we have been listed in top 20 brands in India across all sectors, across all companies. We have continued our efforts on increasing on the retail side. Last year we talked about retail improvement Abhyuday. We had done it about 4,500 outlets. Wasn't the most successful program as a management team. We would have liked it to perform better, but we learned a lot from it, and we have launched Abhyuday 2.0 at 4,900 retail outlets, and we have been at it for last 3 months. Of course, I just wanted to give a metric of volume increase, then without doing anything, my volume throughput of my retail outlets increased because of the demand state-owned enterprises had on their retail outlets. But we measure apple to apple and getting good early results. From the measurable set, we are getting about 100 to 150 basis point higher growth on our 4,900 retail outlets. This is over and above the market growth, which is, I would say, the tide rising. But our Abhyuday outlets are starting to outperform the non-Abhyuday outlets in the market. So, parallelly, we are also focused on non-fuel. It's a small part of our bottom line, but nevertheless something which starts adding to bottom line, and we are very hopeful by end of this March we will start seeing this as a additional line on our P&L in terms of contribution. The sixth area is refinery improvement. That is obviously one of the biggest ones. We do have headroom on our refineries to improve further. There are 3 or 4 things which we are aiming at. First, in the next 3 quarters, as our refineries settle onto the new paradigm, we are going to be increasing sourcing for our internal thing. One of the things which has hit us this quarter is our need to satisfy our marketing footprint by buying from third-party players. That dependence is going to slowly reduce. In fact, if I count my own refineries and the joint ventures, by end of this year, I would be almost self-sufficient, maybe surplus on some products by taking in total of my own refineries and joint ventures. 2 major efforts on this. We talked about HRRL ramp-up, and I'm sure you're going to have questions on RUF. That also we have been in the process of stabilizing. It's a tough technology. We've had a couple of, I would say, unexpected technological challenges on it because it's a high pressure, high temperature kind of a situation. Dealing with tons and tons of catalysts becomes difficult. But we are mastering that art slowly, and this will start giving us both product and consistently addition on the bottom line. In an essence, we are making our assets work more. Our turnarounds are much sharper. They finish bang on time now. We are making a very concerted effort on energy costs because between the 2 refineries on our balance sheet, we probably will be spending close to 2,000 or even more crores on energy. So that's one effort. It will be actually much more if I add fuel and losses. That's one effort we are doing. And I talked about intermediate stream leverage. There are some interesting experiments we have done on buying intermediates to satisfy some of the units where there was potential to look at it. So whether it is BGO or PI gas, we have been making those efforts. Last but not the least, the 3 refineries fully working and then even joint venture of HMEL in the fold, we are looking at even crude optimization across our refineries a lot more. Having a significant storage capacity at Mundra for HRRL gives us the flexibility of doing innovative things like bringing in VLCC there and shipping it to Mumbai in a different fashion. So there's a lot of effort going on our refinery performance. The last but not the least is the effort we've been talking about is on the digital side. Again, it's not only about just the fancy world of AI, but it's hardcore using digital to improve efficiencies. We've been talking in every quarterly call. From the last time to this time, we have launched the supply chain optimization solution. We're working on it. This will help us optimize our movements much sharper in a state-of-the-art tool. A lot of digital analytics use cases are being worked on, and focus is on efficiency measures. So those were the 7 I'll recall. Improving our balance sheet, capex control, lowering the interest costs, profitability improvement program, Samriddhi 2.0, winning in retail, refinery optimization and improvements, and digital. How do we look at the future? As the management team, we look at the future with a lot of confidence. I can look at the last quarter and say, oh, there is this negative. That's fine. It is there. I can't do anything to undo it at this stage, but we are very confident of our future. A lot of foundational elements, some which we will talk and some which we will not talk in this call, are in place. The ones we will not talk, we want the world to see them down the line, and some of you guys to find it out yourself on how this happened. But we look at the future with a lot of confidence. We will be turning around the current situation. Hopefully by the time second call happens, you all would be happier with the numbers. We are coming out of the crisis stronger with a more balanced portfolio and hungrier. That's all I had to say in my opening comments. Thank you for your patient hearing and also the continuous interest in HPCL. As I said, keep your detailed reports flowing. Even if you praise us or critique us, all of them are very valuable. I did mention earlier all the reports which came my way on WhatsApp since last night, the flash reports. I personally gone through all, very interesting comments, good analysis. So keep that coming, and if of course we're happy to take questions now, me and my team, and also if anybody wants to meet us later, we are more than happy to meet you separately later. Thank you, and over to Vajrajan and the team for further moderating the call.
Thank you. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question comes from the line of Probal Sen with ICICI Securities. Please go ahead.
Good morning, sir. Thank you for the opportunity and thank you for the very detailed and extremely useful briefing at the beginning of the call. I just had a couple of questions, perhaps from a slightly near-term perspective. You had, I think, spoken in detail last quarter in terms of the sourcing that you had in place and the kind of number of days of inventory. Can we just get a sense, given the flare-up in the crisis again, how you are looking at sourcing? Q2, I assume, would have anyways been mostly tied up at this point of time. But looking forward to Q3, are you facing any fresh challenges in terms of arranging for sourcing, given what is happening in the Strait of Hormuz right now? And, what's the strategy and what's the kind of mix, if you can throw any color, in terms of how your crude sourcing is looking like, specifically now that your Rajasthan refinery is also up and running. So obviously our crude requirements have gone up to that extent.
Yeah, thanks, Probal. This is a dynamic time, and just to be very predictive on what we are going to do on sourcing is very difficult. Just to give you a sense, at the beginning of the year, we always do a term and a spot mix. This time in the first quarter, we hardly got anything from our term contracts because a lot of the term contracts were sitting on the other side of Strait of Hormuz. Having said that, we are very well covered for our crude till end of August fully. In fact, yesterday we were starting to buy for September. There is always barring one cargo which is stuck here and all, but those are operational things we are able to handle. I'm first talking of crude only, then I'll talk of LPG itself. I think crude availability is not an issue. Pricing, of course, goes up and down and is very difficult to handle given you're always buying dated Brent and 5 months pricing or 2 months prior pricing. So less of a challenge on crude sourcing this time. So we don't anticipate an issue on crude sourcing. There is enough crude which is available. In terms of mix, I think with what is happening and moment HRRL is at full steam, actually the mix plays more into our hands right now because if you look at it, both of our bottom upgradations, RUF is still in stabilization phase, as I said, and Rajasthan, well delayed coker is started, but a couple of units have to get on stream for us to get it full there. But moment HRRL, RUF is stabilized and HRRL is fully at full capacity on the refining section, we actually will be even more stronger position because we can buy even dirtier crude. So on crude, I don't see an issue. On LPG, I think it's once bitten, twice shy. All OMCs have worked very hard to diversify the mix. One of the things, pre-crisis, all of our ships used to be looking at Strait of Hormuz and buying and turning up and down there. We've been buying a lot of cargos from US and other places also. So I think LPG is much more. I think we have learned the drill. There is not a muscle memory now on to do that, on how to do it. Of course, the situation is very dynamic. Things could bombs flying all over is a difficult thing. So we'll adapt as it is. But I'm not worried about sourcing of either LPG or crude at this point of time. Pricing, of course, is a concern.
Got it, sir. And with respect to just the inventory movement that you mentioned, it's fair to assume that there would probably have been a negative inventory impact in the quarter, both for the refining and marketing segment. And that will probably reverse in this quarter, given the kind of spike we're seeing in prices, or it's too simplistic to look at it in that way at this point of time?
Yeah, I think part of the statement is absolutely correct, Prabal. We did have a significant amount of inventory, and also two things happened in this quarter. You should remember that it was very uncertain times to secure more inventory. At least we carried more than usual inventory with us. That was a conscious call we took because, as I said, we were first looking at keeping the throughputs going. So, and also during the month end, some cargoes which are stuck in SOX we landed. So we did carry more crude into our tanks on 30th of June. Obviously, there is a write-down on those given where the prices were, and one can say, oh, you would have anticipated that drop, but I'll be wrong in saying if I would have thought the crude will drop $25 in a matter of 2 weeks there. So to that extent, there will be a reversal automatically. How much? Very difficult to predict because it's now again going up at 95. If it goes to 120, there's a different reversal. If it goes down to 75, there's a different thing. But in July onwards, we are carrying a reasonable amount of marked down crude. We did carry a lot of markdown crude. So July, we've been running markdown crude.
All right, sir. One last question, if I may, just a housekeeping one. What was the LPG loss on a per cylinder basis for the quarter, and what is the kind of level we are seeing right now? I can have sense.
I don't have the quarter number. June it was 680 per cylinder. July it dropped 490 per cylinder. Quarter things my team can give it to you later if you want the averages. I just have the June and July number with me.
No problem, sir. Thank you so much.
For giving some additional numbers. 510 was the whole quarter. For the 3 months. For the 3 months, it was 510 per cylinder loss.
All right, sir. That is very, very useful. Thank you so much. I'll come back.
Thanks so much.
The next question comes from the line of Puneet Gulati with HSBC Bank. Please go ahead.
Thank you so much, and great effort on managing the supply chain in these tough times. My first question is, if you can help me understand how should one look at the refining margin, which you say is without the SAED impact. When you transfer it within the firm from your refinery piece to your marketing piece, do you adjust for a impact of SAED for transfer, or is it full price? How should one think about this?
Yeah, this is adjusted for SAED. So the reported numbers are adjusted for SAED. Sorry, Shivida is just giving an additional data.
Even when our own refinery is transferred to the marketing, it's done after writing down the SAED. So it's net of SAED, the transfer happens.
Okay, so even when you transfer it within the domestic universe, it's an X of impact. Okay. And secondly, on the product side, there was this price increase on petrol, diesel. Would it still have resulted in marketing gains, or is that still counted as at the same price?
For the whole quarter, there is a significant under recovery on this. This has been said even on the public platforms by a lot of people, including high-ranking government officials. So there has been a significant there. Just to give you a sense, the marketing under recovery for the whole quarter was upwards of 26,000 crores. 20 of which was, and these are rough numbers, was on MS and HSD put together, and about remaining was on LPG. So it was a significant under recovery for the whole quarter. Every liter which you and I were buying from petrol pump was being subsidized by one of the 3 OMCs.
Understood. And can you give a sense of, obviously the pricing has moved up again. Is there still significant under recovery at this point of time? And if we account for a combined margin, are you in a better state and in a positive territory at your refining spread with your marketing loss?
Yeah, I think this is a very, very dynamic situation. Just in last 3 days, the crude has gone up, 3 working days, it's gone from 85 to 96. So it's a very difficult one to predict, and given as it is, we have not given too many forward-looking guidances, though we gave some last year. But this is the least time as a management team we would want to give forward-looking guidances. Having said that, I will say that we were happier with July. We hope we'll be happier with August, I would say. No point getting into specific numbers because you guys can do your own backward calculation. You are very smart around it. But it's a very dynamic time. Before we speak tomorrow, if anybody caught the news today, one Saudi product tanker is on fire in the Red Sea. Houthis have done that. So that's at least floating around in the media right now. I don't know whether it's true or wrong. So it's a very dynamic situation. Crude could go 100 tomorrow, or it could drop $10. So we'll have to take it as it comes. But we were happy with July.
Understood. That's very helpful. Thank you so much, and all the best.
Thank you. Participants, in the interest of time and fairness to others, please restrict yourselves to 2 questions. For any more questions, you may rejoin the queue. The next question comes from the line of Amit Murarka with Axis Capital. Please go ahead.
Yeah, hi, good morning, and thanks for the opportunity. So, firstly, on the quantum of the inventory movement, would you be able to ballpark provide that as to how much was lost at crude or marketing?
See, the same question Amit was asked last time. Again, you leave that with us as a number. All I would say, and I made the statement earlier, we were carrying higher crude inventory, and we also were keeping sufficient product for. So, in a normal situation, I wouldn't have carried that much of crude in my tanks, which I was carrying on 30th of June, because we were apprehensive that war could go anywhere all the time. So, it is a significant number. I'll give you one more cue. My team is going to kill me after that. But if you net it off, the loss number would have been on the other side of 5-digit number by a good margin. Remaining, you can calculate yourself.
Got it. And on the Vizag bottom unit, you mentioned that you face some issues with catalyst handling, and also by when do you think you'll be able to stabilize that unit and start contributing fully to margins?
So at 8:45 today morning, my head of refinery told me that he is hopeful of getting it stable very soon. Now, I don't know whether he was evading that question at first. That's the first call I make when I leave home to get to work. Jokes apart, I think let's also recognize that it is a very, very technically complex asset. I've given this in the last call also. Imagine running something at 380 bars at 400 degree temperature. And I told last time, just to see how powerful that reaction is, the walls of that reactor are 25 centimeters thick. So it's a challenging situation. We are learning the art of doing it. Even Lummus, who's the technology provider, has not run. This is the first time they're running a unit this large there. Again, it's a technological leap HPCL has taken. The good thing, it's an engineering problem. And engineering problems can get solved more easily than financial or pricing problems. Our team is working on it. We are getting faster and smoother. We are hoping to have good run on that in this quarter itself, and in the next quarter itself, hoping to have it fully stabilized there. And I remain hopeful God will be kind to us in making our hopes get realized. It will start giving us a significant thing. It will also, as I said, significantly shift HPCL's with HRRL and Vizag rough coming fully on stream. So on a run rate basis, third quarter onwards, I would hardly be dependent on anybody except my own refineries and my JVs for diesel. On MS, I'll probably need only 10% MS from anybody else. So we are in that phase where we are really hoping our assets will start working on it. And as a CEO, I'm impatient for rough to get started soon. But as a practical person, I have to give my team the entire space to get it running and learn the technology. We'll get there. We are very, very confident about it.
Thank you. The next question comes from the line of Yogesh Patil with Dolat Capital. Please go ahead.
Thanks for the question, sir. Capital expenditure side, 1,734 crore kind of a capex during the quarter has seen a sharp reduction on the sequential basis. Could you please share the number that expected capex for FY27? And in addition to this, suppose the FY27 capex might be on a slower or lower side, considering that kind of higher end recoveries and on the oil products, which segment of our company, like refining, marketing, pipeline, or CGD, will take a hit on the capex side? Any broader understanding, if you could provide?
Yeah, I think I gave the understanding on the broad numbers. We said 9,700 was the target we had taken for the year. We expect it to be lower than this. Obviously, we will react to the environment. If the thing is benign in the next quarter, we will spend some money. If it is not benign, we will conserve that money. And 1,700 odd, which we have spent right now, also includes a lot of money which has been spent on buying equipment, catalysts, etc., for the coming turnarounds, which are absolutely essential for keeping our refinery running. In fact, all of the refiners have been delaying turnarounds in the last few months to keep the product flows going. Which segments? I think a lot of it is around discretionary things we would want to do more. Like I can always upgrade 200 pumps in a year. I can upgrade 1,000 pumps in a year. If I have more money, I will upgrade 1,000. If I have less money, I will upgrade 200. On the refining side, the major capex has already been done. There are a few projects going on, but for a company of our size, spending 4,000-5,000 crores on a 4-year, 5-year long project is not too much of an issue. There will be periods where we can accelerate that spending. There are other things where we can spend in terms of, I would say, administrative expenses, upgrading some of our infrastructure. Those things we can always postpone. Like we can do it 1 quarter later. So that's something the management team will take a call on. But nothing critical will be starved of funds, and yet the discretionary spends can be pushed back a bit.
Okay, touching to the same, any number you'd like to share with us for the FY27 capex? And secondly, sir, India has oil SPR reserves of around 5.3 million metric tons. Was it available for all of these oil marketing companies or any refiner during the Q1 FY27? Considering the sourcing?
All reserves, all things were available to everyone. And all I would say, not only HPCL, every single refining company and marketing company, private and public, collaborated extensively during this period to get the country out of the crisis. The amount of collaboration which happened, I guess none of you can even imagine. SPRs were available, our own infrastructure was available for others' infrastructure was available to us. If I was running short on something, somebody else was helping me, somebody else was running short there. It takes a lot of people to work together to get over a crisis like this. It was a non-trivial situation. Many nations bulked under it, but we came out of it because all our companies, whether it is standalone refiners, whether it is private sector refiners, public sector, all of them worked very, very hard on this. On capex, I've already given you numbers. Beyond that, as I've said, this call is not about giving any guidances. We have stayed away from that. We have said the maximum we are going to spend is 9,700 crores. If there is less money on this year, we will spend less than that.
Thank you. The next question comes from the line of Nitin Tiwari with Phillip Capital India. Please go ahead.
Hi, sir. Good morning. Thanks for the opportunity. And at the onset, I would want to congratulate your entire team for navigating this very challenging operating environment. Sir, my question actually was related to your refinery margins. So yesterday, along with you, BPCL also reported their numbers, and the refinery margins have been fairly strong as compared to our refinery margin. So I just wanted to understand in that backdrop, right, that what were our hits and misses, which led to this significant variance between two similarly sized sort of peers in terms of refinery margins. That is one. Secondly, I mean, you did comment on work stabilization and other challenges that we are facing in Vizag, which perhaps could be impacting the refinery margin. But I was looking at the data for last 20 quarters, which is almost last 5 years, right? In this period, we have rarely reported refinery margins better than our peers, IOC and BP. I'm not even comparing it with the refinery margins of private peers, right? So what is that is leading to this challenge in terms of our refinery operations, where our refinery margins are consistently lower? Because in the past also, we've guided for margins to incrementally turn better with expansion of capacity at Vizag and so on and so forth. So your comments on that, sir, and then I'll ask my next question.
Sure. I think on comparisons, BPCL, I will leave it for you to do. Not my job to compare with BPCL. I've picked up the phone and congratulated BPCL CMD on an exceptional performance from their side. Proud of a peer turning out what the numbers are. I have but I have not spent time trying to dig through what were their refining margins. I have enough of work on my hand to do on what are my refining margins and where do I want to be. So I leave that comment on BPCL to you to handle. But remember, they have a higher refining capacity than we have, and there are structural things. Refining is not just an easy job to do; it's a complex thing. On your second thing, I would turn the clock forward 1 year later. You should ask me the same question on the same call, and you will have an HPCL asset which will have the highest margin. See, the margins are generated by the assets we have. And if you understand refining and go deeper into that entire thing, you will understand there are like, if I do not have a delayed coker in my Mumbai, I will not get a refining margin or uplift which say another refinery which has a delayed coker which will have. I have a delayed coker which is already working in HRL. I will get that uplift out there. Second, our uplift on rough will happen, Vizag will happen. That will take our distillate yields up from what it is right now to in 80s. But there is also a structural disadvantage rough has at this point. Vizag has two. One, if I compare it to the West Coast refinery, that's in East Coast. You always have to carry more inventory in East Coast. The crudes are more expensive on East Coast. That refinery also does not have natural gas right now, which my other refineries have. So there are, it's not just an apple-to-apple comparison that if you look at one reported number and compare it with other and say, oh, this guy is good and this guy is bad. You have to look at what is that guy capable. I have two kids. If I have two kids and one is capable of cracking IIT and the other one is not capable of cracking IIT, should I say that the second kid is bad? No. I have to look at what is that kid's capability and what is that kid performing on that. Having said that, we understand we need to improve that entire thing, and we are on track to improvement on that. I hope I've answered your question.
Like that. Yeah, sir, actually, what I was trying to get at is that, as you rightly pointed out, BPCL has a larger capacity, right? I mean, in terms of refining. So, naturally, they would also be carrying a larger inventory. While we were carrying more inventory than we usually carry, but I suppose they also did BPCL, and I'm not getting into specific numbers.
No, you have to go to BPCL's analyst call and ask that question. You can't ask me questions on BPCL on this.
Fair enough, sir. I'm not asking that question on BPCL. I'm just trying to understand the difference in the operation of refineries which could have led to difference in margin. And fair enough, I take your answer for that. Basically, I also wanted to understand this quarter's refinery margin somewhat in detail. So when you say it's before SAED impact, right? So if we build in the SAED impact, then what would be a refinery margin to look at? And if you can give us I mean, I understand that you don't want to give an absolute number on refinery inventory losses, but a ballpark number around per unit basis would be helpful for us for our analysis.
Yeah, so I think you guys are all smart to calculate the SAD impact yourself. If you need help on that, you can always speak to my corporate finance team, Vinod and the team. They can help you understand the SAD impact the way you looked at it. And what was the second part of that question? Inventory, I've already said what I have to say. I will not say anything further on inventory.
Thank you. The next question comes from the line of Sumit Roha with Smart Sun Capital. Please go ahead.
Yeah, hi sir. A very good morning to you and your entire team. So firstly, I mean, I have to congratulate you. It's a very tough environment that you guys have basically been functioning on and kept this, more importantly, kept this country alive. I mean, sir, one thing, it's clearly a fact that the private guys were basically, in terms of market share, also small. But what you have done, I mean, all the three of you have been totally, marvelous. And I'm sure that the country, is definitely indebted to you because you've kept the wheels of the country running. Now, sir, my question to you is that, the matter of fact is that, you've done such great amount of work. Your balance sheet has taken a hit. And of course, you have done this for the country. I mean, there's absolutely no question on that front. Like as we've seen that our LPG today under recoveries or whatever the negative buffer account is about 16,000 crores. And, your marketing also has been subsidized for the best interest of the country, which is nearly to the tune of 20,000 has been highlighted. So sir, I'm sure that the government is obviously, aware about, the sacrifice which basically the company is making, and obviously the sacrifice also comes from its shareholders, right? Because the economic interest of the shareholders also is at stake. So with the great amount of work, the physical work which you guys have put in, and the financial hit we've taken, and with 36,000 crore of under recovery which we've just faced in 3 months, which is staggering. Can we expect that we can expect a substantial amount of government support because this is done for the country itself? And can you please share, if at all possible, your outlook, for this financial year? As you said, it's a circle of life. 22 also we face a similar period, and come 4 years ahead, 26. So I'm sure that what you've done is a splendid job, and I'm sure this company is becoming stronger and stronger. That is clearly evident from the refineries, from the physical throughputs, from the physical outperformance which you guys have done. But sir, from the financial point, it'd be very interesting to get your perspective. Is that, and I'm sure the government looks up to you guys for the great work you're doing. Thanks, sir.
Thanks, Sumit, and thanks for your kind words. On the aspects on how I think first, it's not my brief to talk on what the government's going to do. I think there is a different set of people who should be talking on it. So the questions probably are best addressed there. Having said that, if you read, there's been a lot of talk, and government's been talking about the fact that there was a way things had happened, and there was something which was done to keep the wheels in motion in this while. So I'm sure all those things would be taken into account. They have been taken into account in the past, and I'll draw your attention onto what was said at the analyst meet in Bombay last year, where the then secretary and also the honorable minister actually talked about saying that how the fact that these assets are bulwarks of the keeping the wheels of the nation in motion. So a lot of I would say support is there in different forms. What specifics? This is not the right forum to talk about that. What's our outlook? As I said earlier, very difficult times to predict the outlook. You guys have been tracking these oil markets for years. You will know. Probably you never have seen the extreme volatility which is occurring right now. There have been eras for high prices. There have been era of $20 prices also. But the spikes and the troughs which are happening, the frequency of the volatile nature is kind of unprecedented, and that has its own set of challenges in giving guidance. Having said that, we are very bullish about the future. Why? 2-3 things. One, we believe a lot of homework has been done. Some obvious, some not so obvious. Some giving results right now, some will give results in the future, which make us a stronger company. The fundamentals of the company are being worked upon. All of us are together in it, and everything which is there, work on it. And just as a simple thing, while we did not share and I refuse to comment on BPCL thing, our teams have been analyzing everything threadbare because we also want to see where is an improvement area in us. And not only us, we are looking at every single results which are being declared to find out our improvement areas. Similarly, I talked about a lot of effort going on into marketing side. We talked about the new LPG launch. All those things are things which make the company stronger in the long run. I hope benign conditions come. If that looks at it, no management team ever wants a red quarter or a red year. We are also a team which are very proud, and we will also not want to have red quarter. We cannot avoid at this time, but we would also not want to have red year. So that's all I would say on this, Sumit. Hopefully quarter 2, the results would be better, and then we can be more sure about where the year is going to end. But very difficult to predict at this point of time.
Okay, sir. Thank you so much, and wish you all the very best, sir. Because the only reason I brought this point up is because, today the market cap of 80,000 crores clearly is not justified for the kind of valuable assets which the company owns, right? Today our plant and machinery value is 1 lakh crore, whereas, we are being valued at 80,000. So it just absolutely is absurd valuation, So that was the reason I just brought this up. But anyway, wish you the best of luck, and to you and your entire team, sir.
Thank you.
The next question comes from the line of Abhishek Nigam with Motilal Oswal Financial Services. Please go ahead.
Yeah, hi. So just 2 questions. So what is the landed cost today for
crude. So if Brent crude is $90, then what will be the landed cost in India? So that's my first question.
Difficult to answer in any way, because it will depend on where you are buying, what crude you are buying, because you could buy an extremely light, low sulfur crude which is at premium to Brent. There are other things. There could be a seller which is in a distress, wants to get rid of a cargo. So it's a very difficult question. If you ask me what is my landed crude today of all I'm buying for my refinery right now, I won't be able to give you that number also, because it varies literally from crude to crude there. So my suggestion is, from your calculation purposes, just look at the averages rather than getting deeper, because crude buying is also, there's about 200 different type of crudes floating around in the market.
If we just take Brent, for example, if we just buying Brent, is it fair to, just add the shipping and insurance and, is there some average number that you can get $3, $4, $6 in terms of?
Or is it like you are asking me to predict the oil prices? I was just thinking as you are asking that question, I have no way to give you, and I will throw it open to my team if they have any better guesses, because even in this crisis there are times when you have picked up crude which are discount to the Brent. There is some other crude which is at a premium to the Brent. Every crude goes in at a different thing. There are times when the same, today that crude is at a premium to Brent, 2 weeks later that is actually at Brent, 1 week later it might be at minus to the Brent. And everything is shipping and all is very standard. There is no, of course shipping rates went up in the recent past, but that's a standard thing. So I'm not evading that question, it's just that I don't know how to answer that question. I wish I had that straightforward answer to that.
Fair enough. And so just one last question. So last quarter, I think in June, there was a $200 premium on LPG buying. It was a spot premium. Is there still something like that prevalent today? Or has that completely gone away?
I think two things have happened. One, the Saudi CP price, which is one of the markers, has come down by about $200 per metric ton. The second, as a reaction to the crisis, we have also diversified our LPG procurement mix. So there are, like last time we were almost, in the call also said, and it's been said in public domain by a lot of people, that we were all dependent upon 90% on LPG coming from other side of Strait of Hormuz. Now that dependence, of course, it was not available, but even otherwise there is a systemic diversification which is happening. There are Indian time charters which are going to US to pick up cargoes, which never happened in the past. Now because of the diversification, I'm less dependent on the spot, and as a result the spot prices have cooled down there. Now I don't know what is today after the latest hits which have happened, but by and large they have cooled down a bit. And also we are much more resilient in the way we are buying right now.
Okay. I think that helps, sir. Thank you so much. That's it from me.
Thank you. The next question comes from the line of Maulik Patel with Equirus Securities. Please go ahead.
Hi, thanks for the opportunity. And so just two questions. So you already mentioned about the two things which led to the subdued performance in this quarter. One, you were carrying a little higher inventory at the end of the June, and you had that sharp fall. And second is the Vizag upgradation refinery performance. You said that if both things normalize in your expectation, if you're not carrying them in a higher oil inventory, and the Vizag performance would have been normalized, which you expect in Q3 or Q4 onwards, what could have been your GRM, which you have reported around $24? And just some idea on that, what could have been your number if these two things are not there?
I think difficult to give you a number offhand on that. Again, when I made that statement, you have to look at it in the context of the quarter. If those things were, I would say, things which have moved the needle a bit to the other side of a 5-digit number. But remember, we talked about the overall under recovery of 26,000 crores. That itself is a big number. And HPCL on its own balance sheet carries about 55-60% of our total POL and other product sale. If I keep LPG out of it, or about approximately 55% is supplied through our own PNL. some part is supplied through a joint venture. So we would always have that complexity of some of the numbers, even in the best of the times, falling through the consolidated numbers and others coming to the P&L there. But let's wait for a couple of quarters when all these things are normalized. You will start seeing the uplift in the GRMs. And right now, one thing you should all keep in mind that when you're looking at GRMs, everybody buys crude which is on dated Brent, some with 1 month. I think there were some with 2 month pricing. And this was unusual period. So a high GRM is not only a reflection of performance of the refinery, it is also a reflection on the timing there. So just to give you a sense, again, there are days when I'm running a particular parcel, my Vizag refinery has given me above $30 GRM. And next day when you look at the dashboard, first thing on your thing, that's saying, yeah, kal to ye positive tha, negative kaise ho gaya? Because next day they are starting to run a different, which is at a different price. Yeah. So GRMs fluctuate based on the crude which you are buying. Refinery consistency and their performance is a structural thing which can be altered over a period of time. But on a daily basis, crude, so if I had cheaper inventory in some days on a particular fortnight, say, my GRM could be sky high.
Sir, if you could have an access to the Middle East crude in this quarter, your Vizag refinery performance should have been much higher than what you have reported. Is that an fair understanding?
In some ways, yes, because lot of units in Vizag, see, you all design to certain specs. There is some part of Vizag which is designed to the specs, and maybe Director Refineries can add to it. He's much more knowledgeable on this topic than I am.
In fact, many of our term contracts are targeted at Iraq and Saudi crudes and ADNOC also. So quite a few of them, almost none of them came. So the alternatives are not readily available in the market with the same gold. So that whatever impact we had seen that and gone through that.
Thank you. The next question comes from the line of Gagan Dixit with Elara Capital. Please go ahead.
Yeah. Thanks for taking my question, sir. I have the question about the Vizag refinery. So, your auditor mentioned that highlighted that there is a 26 billion loss in the Vizag refinery, while your headline numbers at the refining level in GRM is very decent at $24. So, can you explain what's the refinery level profitability versus the headline GRM?
I don't know. Yeah. Did you get the question? No. Can you repeat the question? The line had a static in between.
Yeah, sir. My question is that your auditor highlighted that there is at the Vizag refinery there is the 26 billion loss. It's mentioned in the notes actually. So what's the reason is that despite the very strong GRM you reported, sir?
They're just checking up. The team is just checking up. Can take. Maybe
this is 2,635 crores. That is after factoring the inventory losses that I said.
Okay, sir. It's only the inventory losses. Okay.
Yeah.
Okay, sir. And so my next question is that what's the utilization we expect for the Rajasthan refinery in the September quarter and FY27, sir? And so how much of the product that you purchase from the third party it is expected to replace at full utilization level?
Sorry, can you be repeating the question? There's somehow static. Or Vardhanji, if you got the question, you can repeat it, because at our end we are getting some static when the question is being asked.
Sir, my question is about the Rajasthan refinery, sir. So what is the utilization I expect for the September quarter? And also the full FY27 basis, sir.
Sorry,
that's my question.
Please repeat. You just dropped off from the line in that period.
Gagan, in case if you're not using the phone on your handset mode, please use it on the handset mode.
Yeah. Is it better? Is it better now?
Yes.
Yeah. So my question is that this about the Rajasthan refinery. So what is the the utilization I for the September quarter and FY27? And how much is the product third party that you purchase is expected to replace at the full utilization level?
Okay. I think utilization, as I said, we are running at around 60-odd% right now. For the whole, it's a new refinery, so there will always be a few things here and there. But for overall, for this quarter, we are expecting 50% or thereabouts utilization. We are not going to hang our team for plus minus on that because it's a new refinery ramping up. Refineries take time to ramp up. On third quarter of this year, maybe October onwards, we are expecting an 80-85% utilization run rate, and by fourth quarter we expect it to have close to full utilization on the refinery section. Petchem, as I said, will take some time to ramp up, but till that time we'll be able to sell the other products, including LPG, which is always a demand. So we are going to start, literally from today or tomorrow, we are going to start producing a significant amount of LPG at the refinery. On FY27, we would expect, FY28, we would expect a full run on the refinery. We are quite hopeful of that getting stable soon. In terms of what we are buying, so if I just look at first quarter, just take HSD as an example, we bought about 50% is our own, another 27% is through joint venture HMEL, where we have the marketing rights for the liquid products, and another 24% was bought out. If I just do fast forward to next year, 56% of that will come from my own, including the rough things. 40% will be from joint ventures because HRR will kick in at that point of time, and only balancing will come from third-party refineries. Balancing more from, there are some places where it might be better to buy from them because of better serviceability, especially in down south. So that's the dramatic shift we are expecting in the next 2 to 3 quarters, which will, as I said in my opening remarks, which will structurally alter our numbers, and then obviously with HRL coming in and kicking in at good numbers, we would have a different set of comparisons to do next year.
Thank you. The next question comes from the line of Mayank Maheshwari with Morgan Stanley. Please go ahead.